Hey, it's Rick. It's Tuesday, February 28th, last day of February, so it's in the books. Not a great month. So the year's not off to a fantastic start. As always, start with my risk model. No change since last week, everything negative. The 200-day moving average is still flat for both the S&P and the QQQs, but price we're trading below it. So it's if you're not all in cash, you should be, or pretty much there. I think right now I'm 44% invested, and the rest is in cash. So, and with really tight stops. So I'll go 100% cash if need be. Get rid of this. Just looking at the S&P. After a pretty good start in January, then it's just been straight down. We're in really no man's land here. You could argue, let's go over here to the weekly. We are arguably in a bit of an uptrend off the low that was set last October and the low again in December. And as long as we stay above the low that we set last week, February the 20th, you could argue that we're still in a bit of an uptrend. But overall, this is, the bigger picture is down. So I think what's going to happen is that we're just going to get into a chop. And this chop could go on for a few months. I think until we get rid of all the uncertainty about the debt ceiling limit in the US, I can't see that institutions are going to pile billions of dollars into the market until that resolves itself. So I think we're resigned to the fact that the market's going to be just garbage from now till probably the end of summer. If that resolves to the positive, I think, and assuming inflation dies down by that time, and assuming we don't have another escalation of the wars, so on, and other bad things happen, I think we could get into a rip-roaring bull market late this year and certainly into 2024. So you want to be positioned for that to take advantage when the time comes. But right now, it's not time to be in the market. There are individual stocks that are setting up and can do well. But that's, again, it's not for most of you. Most of you are content to just park money in the indexes or potentially into sectors. So you can try and help you there if you like, but by and large, it's stay out. Similar picture. I mean, it's a similar picture for all of them. The Qs doesn't look much different. Slightly stronger than the S&P 500. The Dow, and this is only 30 stocks, so I don't really pay much attention to it, but it's already just in a sideways zone here. So we bounce up or we go down or we just chop around in here. The mid caps haven't looked at for a couple of days. They're still staying stronger. So these small cap or mid cap companies from 2 billion to 10 billion market cap seems to be where there's a bit more promise for stock picking. Small caps, similar, not quite as strong as the mid caps, but still a little bit stronger than the major players. And Toronto, I haven't looked at actually for a couple of days. Yeah, it's still in the crap zone. So there's just nothing here. So now that February's done, I will just share as I did last month, I'll share my statistics for the month. I'm a nut for keeping track of things, and for those of you that maybe you're trading a little bit, I would encourage you to keep a journal and keep statistics on your positions and how they work out, so they can really help you in the future. But to each their own here. So in February, winning trades, 20 versus 15. So my batting average this month was 57%, which is that's a nice improvement from last month, which was 33. I'd like to keep it greater. For the year, I'd like to be greater than 40%. 50% would be sweetness, but I'd be content to get over 40%. My average win was down this month, 3.9% over January, and marginally ahead of what my average was for last year. And that's just indicative of the market being crap in, let's go back to the S&P, market being crap in February. So there just was no opportunity to get some bigger gainers, or very few anyway. Average loss, though, I'm 1.9%, so I'm still keeping it under 2, which is where I'd want to keep it. If I can keep it there, get the average wins up, it's a winning formula. What I call my average initial risk, this is the risk that I put on the minute I open a trade, what I'm exposed to if it all went to crap and right after the get-go. I reduced it this month to 2.3%. Which seems to be my historical last year's average. And then the reward to lose ratio. So this is basically taking the average win divided by the average loss. And I was 2.1 to 1 this month. Not ideal. 2.5 is much better. I'm averaging 2.9 for the year. But you can make a living at 2 to 1. But I much prefer this to go 2.5 or greater. I only had 30% of my trades, so out of the 20 winning trades, only 6 of them got me 3R or greater. So what that means is if I'm risking $500 on a trade, to get 3R means my booked profit would be $1,500 or greater. So only 6 of the 20 accomplished that. So again, that's indicative of kind of a crap market this past month. Number of losing trades, they're greater than 1.5R. So again, if I'm risking $500 and I lose more than $750, that's an oh shit, like something's gone wrong. Normally these would be, your losing trade should be 1R, 1.1, 1.2, accounting for some slippage. I did have one position, I got stopped out for a 16% loss. It was a biotech company that had an unfavorable ruling, or well, I don't know what. Anyway, it hammered the stock down. Fortunately, I just had a tiny position, so it didn't hurt me badly at all. But that kind of stuff's going to happen. Last year, in the whole year, I had 29 trades that were 1.5 or greater losses, but that was just stupid bad management on my part, most of it. There was a few gap downs I couldn't do anything about, but by and large, this was just my own stupidity. Average days for winners is 12. I don't have no benchmark to compare to, but I am now starting to track that. So 12 days holding on to my winners. Average losers only held for 4.7 days, which is the way it should be. I mean, you're going to hold your winners longer than your losers. The S&P for the month was down 2.5%, whereas my account balance in total, the sum of all the accounts, was up 0.7. Nothing to write home about, but I don't mind showing a gain when the overall averages are losing. So I'm just, for the year to date, for the 2 months, I'm just slightly ahead of the S&P 500. So not a bad month, considering the conditions. That's really about it to cover. Like I say, there's not much to do for the majority of you that are investing indexes. We're going to be chopping around here for a while, so just sit tight on your cash. At least nowadays, if you do have a pile of cash, it's time to get in. I think it's time to get into some 90-day T-bills or something like that. You can get 4%. At least you can get something that's more meaningful than we did this time last year when interest rates were, you're only able to get like 1/4, 1%. So if you have any sizable amount of cash, I doubt that the market conditions are going to be conducive to plowing it in here. And so you might consider some money market funds. Okay, that's it for tonight, and let's hope March is better. March was my biggest month, best month last year. Where's March last year? But you can see here we had one big week up, another week up, and another week up. So I did very well this time last year. I don't think we're going to see the same thing this year, but who knows? We don't try and predict, we just follow what happens. Okay, have a good evening, everyone.